Most people buy stocks based on emotion. I do not. These 3 companies are on my buy list right now, not because they're popular. In fact, in order for stocks to fall in price, that voting machine has to say, this company sucks. But I'm buying them because I think they're worth more than what they're selling for. The story doesn't match the value. I'm going to show you how I know this and the price I'm waiting for. Every month, I evaluate dozens of companies, but only a few will check every box, of which it's great business, undervalued price, and a margin of safety. And right now, these 3 stocks meet my criteria. And one of them, I think it could be the single best risk-adjusted opportunity on my radar right now. But more importantly, in this video, we're going to help level you up by giving you the tools and principles. So the next time that you analyze a stock, you're going to have an advantage over 99% of investors in the entire world. Stock number 1, Target. Now, guys, Target went through quite a few problems recently. The biggest thing was that their theft was going insane. What we're trying to do here is go over the basics and get a little bit more advanced as the video goes on. So no matter where you are in your process of investing, whether you're brand new and trying to learn, or you're advanced and trying to learn more, you'll get value out of this through repetition. So Target right now is selling for $106 per share. I currently own it. Mo, do you own it?
No.
You don't own it. But remember, just because somebody on the internet owns a company does not mean you should. We're here to teach a process. It's a $48 billion market cap. Now, it's got a big enterprise value, and that difference between the market cap and enterprise value is essentially their debt. Now, here's what's interesting about Target. I always hear people saying Target's dead. Well, the reason they say it's dead is because you look at the all-time high price of $242 and the stock hit a low of 86 recently. That's why people think it's dead. Guys, the stock market price does not tell you whether a company is awesome or bad. It just tells you what is the market. What are the people in the market feeling about the company right now? That's it. Your job as an investor is to look at price and determine a value. And if the value is above the price, you're going to want to pull the trigger in most situations. But right here, we have a company selling for 13 times free cash flow, 11.5 times earnings. And look at this. Free cash flow of $3.5 billion in the last 5-year average of 3.74. So pretty consistent. Now, does that mean Target is phenomenal? No, there are still issues for Target. The world is still changing in how it buys things. Mo, do you ever buy from Target.com?
I have, but it's sparingly.
My sister-in-law is obsessed. She says they make it so easy to deliver, pick up, return, all that stuff. So I love the fact that that's still going there. Look at this, Mo. 4.25% dividend yield eats up $2 billion of their free cash flow. Right now, I still think this is safe.
Yeah.
Because it's only like what is that? 2/3, not even 2/3 of their free cash flow is being given out in dividends. Because Target's got a lot of stores. So that reinvestment opportunity is probably a little bit further out. It's a little bit harder for them to grow from location standpoint. Now remember, we're looking at all these metrics. We're looking at these to come up with our story so that we can put it into our stock analyzer tool to determine what price to pay for the company. Now, Mo, from this standpoint, we're looking at this thing and saying, okay, consistent profit margin, around 4%, gross profit margin, 28%. Walmart, by the way, is about 25%. So they have a higher gross margin than Walmart. But other than that, I mean, it's like, okay, yeah, the revenue growth in the last 3 years have been stagnant. But I also look at it as going all retail in general. I mean, look at Home Depot and Lowe's.
Yeah, it's gotten pretty stagnant.
Yeah, and Target's considered kind of like the higher end Walmart, right?
Yeah, the market cap of this surprises me. $48 billion versus Walmart. You know how much Walmart market cap is?
I mean, it's in the hundreds of billions.
$782 billion.
Is it really?
Yeah. Isn't that crazy? The discrepancy between the two?
What does Walmart do in revenue?
Oh, well, yeah, $685 billion.
Yeah, so it's 6.5 times more. Well, no, it actually still doesn't. Because what's 6.5 times 50? It's 300 and some billion.
No, you're right.
What's Walmart's bottom line margin? What's their profit margin?
Let's see, 2.75%.
And this is a higher profit margin.
Interesting. You're right about the gross margin. They do 25%. 24.88.
I didn't even know that, Mo, about that. I didn't know Walmart's market cap was $700 billion.
Yeah, almost $800 billion. Wow.
So, Mo, something that a lot of people are starting to really enjoy in the videos again is looking at the charts. And guys, the reason to look at the charts is the great thing about reading charts, you don't have to worry about the fundamentals. So it's a way to make money as you're sitting there waiting for the fundamentals to really show in the price. So, Mo, what is the chart telling you right now?
So here's what's interesting. If you go back to 2023, you can see that there was this big kind of bottom that they had. And now I drew this yellow line here. We're kind of at that resistance point. Now, this is interesting because we're coming through what's called the sweet spot, the highest probability to make money. But even though it's coming through, it's giving us a positive trend. It seems like people are participating in the stock to go long. We're hitting this steel eye beam. It's very difficult to break through this resistance point. So it's going to be volume that drives this. They have earnings coming up pretty soon. I think that could be like a volume-driven event.
Do you trade through earnings?
I do not, no.
You don't?
No.
Why don't you trade through earnings?
Because it's a crapshoot. I mean, you've seen the videos that we've made. They could beat on, they can crush in earnings per share and revenue, and the stock price is down 40%.
And vice versa.
And vice versa. Like, it's crazy. It doesn't really, price reaction doesn't have to do with what the earnings was.
Yeah, it's incredible, isn't it? All right, so guys, let's look at analyst estimates here for Target. Now, here's what's interesting. They have in the next year making $8.61 per share, growing to $13.17 in the next 4 or 5 years. Guys, remember, these are analysts. They have their opinions. They have their biases, just like we all do. So keep that in mind when you're looking at things. And look at the revenue growth. Stagnant for the next 2 years. And then about inflation, what you'd expect, 3 to 4% each year. We look at all these things. And this is why the stock analyzer tool is so wonderful. It allows us to marry the story and the numbers together to come up with a price. We put in our low, middle, and high assumptions. We look at revenue growth, profit margin, all these things, and it says, hey, 10 years from now, if you want to make decent money on this, this is what your return would be buying today, and here's what the price you should pay to get the return you want. So let's look up Target the last time I did it. I started buying Target under 130. It fell to 103, skyrocketed to like 180, 190. Everybody's like, oh, Paul, you're a genius. I'm like, no, I'm not. It's just short-term fluctuations. And then it fell to 86. These are the things that happen if you can't stomach that. Yet, stick with ETFs. But over time, you can get better at this and stomach the idea of a stock falling. So, Mo, I did a 10-year assumptions. I did 2, 3.5, and 5% revenue growth.
Good.
I think so too.
Yeah, I think so.
Profit margin. I did 3, 4, and 5%. Same with free cash flow.
I like that.
PE, guys, yes, the last 1 year's return on capital is lower, but this was increasing over the last 10 years. So I put 15, 18, and 21, and I could make the argument for a higher PE and price to free cash flow.
I agree with that.
So why does this matter? Guys, this tells you how good the company is. What kind of return do they get on the money that they invest in their business, okay? Now, making good assumptions here is tough. But in our community, this is why people talk about this all the time. We look for good companies at good prices, not what's just in the news, okay? So I did my 9% desired return. Now, guys, this 9% return is purely to come up with my intrinsic value. This is not the return I actually want in the company. You have to determine what you want. You need a margin of safety, some sort of higher return. If you just want 9%, invest in a low-cost ETF. Don't have the hassles of buying a company. So, based on intrinsic value, I hit the Analyze button. I have a low price of 100, a high price of 250, a middle price of 165. That means if my middle assumptions occur based on today's price, I can expect about a 15.5% return. This includes that dividend. So don't add the 4% dividend in there. That seems pretty solid. The question is, do you believe my middle assumptions? Like I said, we're looking for good companies at good prices. This is very, very important. The news will shift on every company out there at some point. Look at Tesla. 4 years ago, Meet Kevin, Kathy Wood, said that this year Tesla would be selling between 6 million and 10 million cars. What are they going to do this year? 1.7 million?
And they're on the decline.
And on the decline, everybody hates Elon now. Do you see how news shifts so much? Stock number 2, Nike stock, guys. This is a company that we love talking about because years ago, when the stock was at $180 a share, we said, listen, we'd be interested under 100. And what did people say to us, Mo?
No chance.
No chance was
Never
exactly what
gonna
we
happen.
said. No chance. And guys, we have 52 community members who have voted on Nike. And remember, if you're in our community, go in there because this includes the last 6 months of people's votes. The average rating is a buy. We have several to sell and some at a strong buy, but there's a lot of buy ratings on here. I love the fact that our community looks at a great company and says, oh man, that stock is down 60%. Let me take a look. That's what we want. All right, so $116 billion market cap. Look at this, 5-year average free cash flow of $5 billion. Last year, only 3.3. They've admitted that they're working through a lot of tariff issues and a lot of removing how they're selling.
Yeah, they're trying to go more direct to consumer.
Yeah, which is a lot higher margin. Why is that higher margin? Well, guys, if they sold a pair of shoes to Dick's Sporting Goods and Dick's sells it to you for $250, they're selling it to Dick's for like $125 to $150. But now they sell it directly to you, they're selling it for $250. They're getting half that money back, boom, just like that. So they can spend more money on advertising, promotions, things like that. That's what's very, very important. Now, Nike also has a dividend, about 2%, and it eats up $2.3 billion in their cash flow. I think they can still support that. High returns on capital. Their 5-year return on capital is 20%. This is very high, guys. This company gets a great return on the money invested in their business. 10-year, this is what I'm surprised about. 10-year growth rate, 4.23% in revenue. 5-year, 4.36. 3-year, flat. Okay, let's go check out their 8 pillars. Oh, interesting. This is what I'm interested about.
There we go.
You look at this and go, oh, look, valuation. Why does Paul own this? Well, we'll get to that. This company is a moat. This company, if I ask 100 people, what's the number one sports apparel business? How many are going to say Nike?
I would say the majority.
Definitely the majority.
Right.
Question is it 51 majority or like 85?
Yeah, exactly.
Yeah, I agree. And because of that, they have the best basketball players in the world. They used to have the best golfer in the world until he went and started Sunday Red, which is the most ridiculous. I've only seen one person ever wear a Sunday Red thing in public.
Terrible.
Actually, I saw a cashmere hoodie they had the other day, but it said nothing about Sunday Red on it. It was just a cashmere hoodie. And I was like, oh, it's pretty nice.
So they also have number one, Scotty Scheffler. So
yeah,
they still
that's
have
right.
a number one player in the world, but you said moat.
Yeah.
What's a moat?
Okay, so good question. I should explain that to people who are new to the channel. It basically says a castle has a moat around it that protects the castle. So the moat for Nike is they have a great protection on their brand. They're out in all these different athletes. It's hard to penetrate the Nike. Like if I said to you tomorrow, Mo, I'm going to give you $100 billion. Go compete with Nike. Even with $100 billion, it's
going to be hard.
That's going to be very, very difficult.
Just to get into their brand name.
Yes. Mm-hmm. So they have a protection to their brand and a protection to their business. That's what's important. Companies like that deserve a premium. So Mo, show us the charts on Nike because they've had a surge lately. They were at a 52-week low recently. What was their 52-week low recently?
Let's see here.
$52 a share.
So this over here on the chart, this is actually COVID. They were below COVID levels. And that's when I was like, okay, when you get below COVID levels, there's usually, that's a very big support level. So what's going to happen? The stock is going to get sucked right back up, and that's exactly what happened. I thought this would get to about $75 a share. Here we are at about almost $80 a share. Now, at this point, there's a lot of resistance. It's probably going to slow down here. Again, volume's going to drive it through. They have earnings coming up at some point. It's on October. They already reported. So, but let's see if the volume from the past earnings that just happened really continues to push this through.
You always talk about volume.
Yeah.
So volume's a big thing for breaking through if it's buying volume, breaking through resistance levels.
Correct.
And if it's selling volumes, breaking through support levels
going down. Yeah. If you think about it this way, you're pushing a boulder up a hill.
Yeah.
Would you rather have one person pushing that boulder or 100?
Yeah, you're right. That's a good analogy.
Yeah.
All right, guys, so let's look at analyst estimates for Nike. Now, remember, analysts have their biases, but look at this. $215 a share growing to $523 in the next few years. So a lot of the analysts are kind of bullish about this. Yeah. And revenue growth, all right, big declines here for 2 years and then back to mid to high single digit growth here. 4, 5, 6, 7% revenue growth levels.
Maybe they're saying that's when the direct to consumer gets figured out.
Or all these tariff things happen. And, I think a lot of people are still apprehensive about the economy. Because think about it this way. If you're going to buy a $200 pair of shoes, are you doing that when you're concerned about the economy or when you're gung-ho about the economy?
Gung-ho, obviously.
Yeah. All right. So our stock analyzer tool. Story, numbers together. Well, I did 10-year analysis. Okay. I did 3, 5, and 7% revenue growth.
Hey, that's good.
Okay. Profit margin, I did 9, 10.5, and 12, and same with free cash flow. Now, key here, I did 12. What's your apprehension?
12.
Why did I do 12?
Direct to consumer.
Correct.
Yeah.
If they nail direct to consumer,
they'll get there.
Definitely. They should get there. PE, 19, 22, and 25.
That's good.
I could make the argument that it was 22, 25, and 28.
Yeah. Premium company.
Definite premium company. And again, my 9% desired return. Now, guys, remember, believe it or not, though, 20 years ago, I chased hot stocks. I followed useless tips. I got caught up in the hype, hoping that something would stick. But I realized very quickly after losses, that's not investing. That's gambling. And that's exactly why I created Everything Money. I always loved teaching. I'd go to my high school and teach a free class every week to the high school kids. I wanted to give young people the tools and the strategy that I once needed, that I didn't realize I needed. And then we added the community. The community is what I never had when I was learning about investing. I assure you that if I had a channel like this back in the late 90s, it would have clicked with me immediately because I look at the things I said and did back then, and this would have made perfect sense. So when you join Everything Money, you're not just getting our amazing software. And by the way, this stock analyzer tool is used over 1 million times per year by our users. Over 1 million times per year. And guys, we haven't even scratched the surface. There's all these other tools up here. We have exclusive content, hundreds of videos that only people in our community get. We integrate you into the community by allowing you to watch these courses so that we all have the same foundational thought process. And we get you engaged in our community of like-minded investors who all want to level up their investing no matter where they are on the spectrum of investing skill. Whether you're a beginner or more advanced, we have both levels, and that is what's awesome. These tools will support you along the way. And guess what else? We're adding a brokerage to the platform. Now, it's not going to be our brokerage. It's going to allow you to use your brokerage, log into your account, and make trades and buy stocks and sell stocks through our software, through your brokerage. We're never going to have your money. It makes it easier than ever for you to level up your investing game. You keep your money at your brokerage, you just integrate it with our software. This is the next chapter for Everything Money. We want serious investors to be part of it. I need to reiterate that. If you're always chasing the next shiny object, we're not for you. If you have done that and want to change, we are for you. If you've already moved on from that and just want to get better, no matter what level you're at, we're for you. If you're not ready to follow a process and stick with it and put in the work, don't sign up. You're just going to be wasting your time and money. But if you're committed to investing the right way, you need to start your 7-day trial today. Click the link below. We limit our spots each day, and we don't know how long we're going to keep this going because we've had conversations about making this an application-only community. So if you're serious, this is your moment. Now, Mo, hit the analyze button. I have a low price of 50, high price of 109, middle price of 75. So right now, it's based on my assumptions, it's appearing to be at fair value, right? And I was probably putting a higher PE in here before for myself. So I'm looking at this saying, guys, at 180, people thought we were probably crazy for saying these numbers, but guess what happens? Crazy crap happens all the time, and before you know it, stocks are selling for the right price if you're patient. And another reminder, this isn't about what's cool in the short run. It's about what's mispriced and strong in the long run. And this next stock, I talk about all the time, I believe is my biggest current opportunity. But as we all know, in order for it to be such a big opportunity, there has to be a lot of hair on that deal. Southwest Airlines. Guys, and guess what? Our community members, they think that I'm probably wrong on this. They have this as a hold. I love it. I can go through all these metrics all you want. My play on Southwest is very simple. Profit margin here. 5-year average is 0.4%. 1 year is 1.4. Before COVID, they did 10 to 15%. They had 48 years in a row of profitability. They've had 1 year of loss, and that loss was the COVID year. They've had some issues lately with computer systems. They're 737 with Boeing, but they are a good operator who hedge their profits very well. Now, that's my entire thesis here. Let's see what the analysts think. But before we get to that, Mo, what are the charts saying?
So I drew these two lines, and this is your support at the bottom and your resistance at the top. And you can kind of see, yes, the stock does break out every once in a while, right? That's going to happen, but it always gets sucked back into that channel. So if it was me, I would trade this between these two numbers. So I would trade this between, call it 28.50 and 34.50. And every time it just goes, it basically is telling you when to sell it and when to buy it when you're trading it, right?
Yep.
And these are some of the easiest trades to make because you know where your guardrails are.
Now, trading has its emotions, but the emotions aren't based on the story of the company. Listen, I don't believe in Bitcoin. I believe in trading Bitcoin.
Yeah.
I don't care what the asset is. I just care about the price movement, which is different than investing.
Oh, yeah.
Now, guys, here are the analyst estimates from analysts for Southwest. $1.18 in profit this year, growing to $4.25 in 4 years. Guys, this is a premium company because of the airline. It's a tough business. It's an airline. It's in the airline industry, and that's my biggest concern about this company. But let's say it's a 20-time PE, that makes this company an $85 company. $85 in 4 or 5 years, if you believe this. And look at the revenue growth. It's at record revenue. It stalls out a little bit.
Yeah.
But guys, I look at this company growing from $28.5 billion to $31.5 billion. It's not going to be a grower. But if they can get back a little bit to their historical margins, what does that mean for the company? Well, let's go look at the stock analyzer tool. It would be a shower then. That is correct.
I could not do it.
You couldn't do it. Well, Mo, here's the shower that is Southwest. I did 2%, 4%, and 6% revenue growth in the next 10 years.
Okay.
I did 8%, 11%, and 14% profit margin. Remember, it was 10 to 15%.
Right. It looks bad when you compare it to those numbers, but where it was.
Can it get back there? Even if it doesn't get all the way back there.
Right.
PE, 14, 17, and 20. It's still an airline, but it's a premium company, 9% return. Here's what's impressive. Hit the analyze button. I have a low price of 56, high price of 160, middle price of 100. Look at these potential returns. This is an example where even if I'm wrong in this company, I don't think I'm going to lose a lot of money. That's the mispricings we want. Now, guys, every month, I also buy SCHD because even though I'm buying individual companies, they have to be at the right price, but I dollar cost average in SCHD. Now, earlier this year, guys, I picked 7 stocks, Southwest included, to go head-to-head with the Magnificent Seven. I created my own Magnificent Seven, and guess what? To my surprise, in the short run, mine are winning. I'm not just talking theory. I'm putting these stocks to the test, and they're outperforming the market's biggest names. I own all of these 7 stocks. So click on the video on your screen to see which stocks are beating the Magnificent Seven and why they could keep coming and winning for years to come. Thank you for your time.